Good afternoon to all our dear clients and advisors. Welcome to our Bright Talks webinar entitled Money Mindset, a Guide to Behavioral Finance. My name is Claysa Solidum from Slamsy Agency Sales, and I will be your host and moderator for today. This is a very, very interesting session because we will talk about you as an investor, your behavior, your biases, and how these influence your investment decisions. And not only that, we will also talk about current issues related to the market during our fireside chat. So make sure to stay with us for the next 1 hour to maximize your learnings for today. Right now, before I introduce to you our guest speaker, allow me to just give you the outline of our discussion. So, as you can see on the screen, for the first part, our guest speaker will talk about different investor behaviors. What we've been noticing is that when markets are down, investors are selling. When markets are up, investors are buying. But is that the right thing to do? We know it's not, right? Because it's counterintuitive. But why do we keep on doing it anyway? We will learn more about these as our speaker will discuss behaviors such as loss aversion, overconfidence, herding, and anchoring. And after that, we will have a fireside chat joined by our very own head of global funds and OIC head of equities, Mr. Miko Vergara, where we will talk about these hot topics on inflation, US debt ceiling, US recession, and interest rate hikes. Okay, so if you have any questions, feel free to type it in the Q&A pod at the bottom part of your screen so that we can address them later on. I'm sure everyone here is really excited for our discussion today, so let's begin. Our guest speaker, ladies and gentlemen, is an executive director, a senior client advisor for Southeast Asia Funds team at JP Morgan Asset Management. Based in Singapore, she is responsible for client relationships across South and Southeast Asia with focus intermediary and institutional clients. Prior to joining the firm in 2015, he worked for the Tisco Financial Group in Thailand, where he was responsible for product development and managed for banking, asset management, and securities business for the group. He began his career for over 14 years ago at HSBC, where he held roles in private wealth management and was an investment strategist responsible for investment and asset allocation strategies. Ladies and gentlemen, let's all welcome all the way from Singapore, Mr. Anis Tiasiri. Hi, Anis.
Hello, hi, good afternoon.
Good afternoon. You're loud and clear here.
Great, thank you so much. So thank you very much for that very, very kind and warm introduction, Clay. And a very good afternoon to everybody on the call. Joining you from Singapore, but hopefully next time we do this, we could do it in person somewhere in the Philippines as well. We're very happy to travel down back there again. It's been a couple months since I've been back to Manila and the rest of the Philippines. So now today's discussion is going to be a little bit different than your usual sort of like financial update or macro update, although we have a session earmarked for that towards the end of today's webinar. Now, I'll be spending the next sort of 30 minutes walking you through some of the observations that we've noticed with clients within the region when it comes to investment making decisions. And the question that some of you might be asking, although it's relatively intuitive, why are we talking about behavioral finance today, right? For those of you who may not have remembered, or thankfully, if you were unable to participate, you might have had a bit of a better time, but 2022 will go down in history as one of the most difficult years to make money in the history of the world, right? It was a year where cash was the single best performing asset class globally, for the simple reason was that cash didn't lose any money. Whether you invested in sort of global equities, single country equities, even government bonds, right? 2022 was an investment environment where everything lost money. And it was exceptionally uncharacteristic, given the fact that you would have assumed stocks and bonds would diversify from one another. But in 2022, bonds drew down as much as equities. Just for context, the bond market performance last year was the worst in nearly 60 years going back in history. So just to give you a bit of context, and that leads a lot of investors to sort of like having second thoughts and doubts about the validity of some of their investment decisions. And I think, as Claysel mentioned earlier, a lot of investors, at least in some points in time, were thinking about sort of cutting their losses in 2022, really selling at the bottom. But I think, as we all know, Finance 101, buy low, sell high. But how can we reconcile all these things? And I think the best way to do that is really understand what could be driving my decision making. Now, some of the concepts I'll be speaking to you today will sound relatively simplistic. However, like it's important to recognize why you're making certain decisions, and everybody's guilty of this. Myself, everybody, our portfolio managers. But the key here is when making these decisions, what are they driven by? If they're driven by rational thought, investment thesis, and things that have actually been thought through, that's fine. But if my decision making, if my portfolio rebalancing is driven by my emotional feelings, that's an area where you need to sort of like question yourself and actually revisit the plan. So let's start with the 4 topics we're going to be talking about right now. The next page, please. Now, I was doing this seminar about 2 years ago. And at that point in time, you guys will remember back in 2021 and sort of beginning of 2022, markets were great, right? This is before Russia invaded Ukraine, just to give you a sense of sort of like where in time we are. And at that point on, I was actually starting from left to right. But given how bad the markets have been over the last year or so, although this year has been much, much better, why don't we start on the right-hand side first with loss aversion? And I think this is an area of, this is a topic which I'm sure a lot of investors will be very, very keen to hear about. So let's start on the next page, please. Move to the next one. Great. Loss aversion and risk aversion. I think this is very, very, these two things we need to discuss in a little bit more detail. There have been many, many psychological studies that have indicated from at least 2 times to up to maybe even 10 times. The feeling of losing money, right, is at least 2 times more painful than the actual pleasure of actually making money. And this is why, and this has been clinically proven, right? This is probably the reason why a lot of people tend to lead loss aversion with risk aversion and sort of correlate the two. Sure, you don't want to lose any money when you're investing, but at the same time, what you also need to understand is that periods of time when markets do draw down, the way we think about it, as long as you've done the homework, as long as the research is sound, as long as the outlook is good, as long as the companies you're investing in are still making earnings, that will actually reward over time. So I think Warren Buffett says this a lot. When the market goes down, he's very happy because that allows him to buy a company that he already likes at a much cheaper price. So for us, uncertainty, volatility, we view that more as an opportunity. For me personally, typically in bull markets, I'm a little bit more hands-off, but in more volatile markets or even big market drawdowns, that's when I tend to get a little bit more active with this particular mindset as well. Really is that when the market goes down, as long as you see structural fundamental forces, uncertainty can be rewarding. What does that actually look like? So if you go to the next page, please. Now, I mentioned earlier in my opening remarks that 2022 was a very difficult year because that was an environment where both stocks and bonds lost money, which that never actually really does happen. So this graph goes back all the way to 1990, and it shows the performance of, in this case, global equities in green, and in gray, and global bonds in green. So what you can see here is that in general, right, investing in a balanced portfolio works. There are much more bars in the positive than there are in the negative. And this is the other key thing here is that whenever you have a performance that draws down, the following year tends to be really, really strong from a performance perspective. So in reality, when markets do draw down, that's the point in time when you should be picking things up. And you can see it time and time again. And it becomes very obvious when you look at it on a chart like this. You saw that back in 1990. You saw that right after the dot-com bubble from 2000 to 2002. The following year in 2013 did really, really well. You saw that during GFC in 2008 and look at the performance in 2009, right? Imagine if you had bought at the bottom there. And even last year in 2022, where you can see both green and gray drew down together, right? And again, that is highly unusual. Just examine the rest of the chart, right? We've already seen the beginnings of a bounce back in 2023. So we are not too late yet. So I would say for investors who had missed the boat on sort of October 2022, where we hit the bottom of the market, we're nowhere near at the end of the rally yet. And again, and we'll talk about this towards the end. There's a lot more things to drive market volatility over the next coming quarters as well. Now let's dive a little bit deeper and let's flesh out this concept a bit more on the next page, please. What this page shows you, similar concept, but a little bit different. Here we took the S&P 500. We drew the performance back all the way to 1980. Every single one of those bars is an individual calendar year. And when I mentioned earlier that volatility means opportunity, this is what I'm actually referring to. Those gray bars denotes the full year's performance in the S&P 500. Those red dots shows you the absolute single worst period of time in that year, the maximum drawdown of that market in that particular year. And what's really, really interesting is that despite, on average, the market dropping by about 14% in the US, 32 out of those 43 years, the market ended with positive returns. So the key here is to not view drawdowns as doom and gloom, view them as opportunities, stress test your portfolios, stress test your hypothesis, and eventually in time, that typically leads to much better performance. How much performance, you may ask? So if we go to the next page, that really just shows you what I mean. So we've put together a couple of different periods of volatility, let's call it that, over the last several years and decades. And we've plotted the performance of the S&P 500 right after these spikes in volatility where the market drew down. You can look at sort of Desert Storm. We went back really far there. We went to Asian financial crisis in 97. We went to post 9/11. We went to GFC, European debt crisis, COVID-19. Every single major spike in volatility, 3 months, 6 months, 12 months later, you can see the performance of the stock market there. The key is not timing the market, but the key is looking at opportunities to come back into the market where valuations are attractive, where volatility is really, really high. So if you take all this together and sort of average it out, that's on the next page. What you can see there is that on average, you're getting around double-digit returns during periods of market volatility. So imagine, again, in hindsight, if you were to buy equities in the middle of last year in 2022, you're more or less sitting up until these numbers as well. So volatility is not necessarily always a scary thing. Volatility breeds opportunity. Now, that's number one, loss aversion. Don't always be scared when the markets go down. That is an opportunity. But we'll go to the next page, please. And this is kind of really the flip side of that. What if you are very, very confident in your abilities? Let's say, for example, I spoke about how markets drew down a lot and that's an opportunity. But you're thinking right now is, wait a minute. If I can tell the market's going to draw down, I have all this data, I have all these averages, I am definitely going to be able to time the market and time my entry into it. Are you though? So on the next page, what we've done, and again, this is just a bit graphical here, but we've actually like gone through the data a little bit, and another clinical study basically polled a random set of men and women across the US, asking them to rate how good their driving skills are. Right. On average, the response rate was 93% out of 100. I'm an excellent driver. At the same time, they've asked both men and women separately, how good of a life partner do you think you are? On average, the result out of 100 was 84%. Is that really accurate though? Or is that number potentially closer to 50%? We don't have the right answer, we're just putting it out there. Some other notable examples of overconfidence on the next page is, for example, Albert Einstein in the 30s saying that there will never be nuclear energy in the world. The chairman of IBM thought that the world might have maximum 5 computers. I'm surrounded by at least 3 in my own room right now. The head of the Decca recording company said that guitar music was on its way out, so refused to sign the Beatles. And a bit more closer to home, the head of AIG, if anybody remembers AIG, said that in no possible scenario could they end up losing $1. And we all know what happened to AIG during the great financial crisis in the US. They no longer exist. Now, to put that into more practical terms, what we've done is actually we've looked at another study on the next page, and we basically went to the track. And what this study basically did, it was basically looked at people trying to predict who was going to win in a horse race. We gave them one set of data, for example, the weight of the horse. We gave them 2 pieces of data, the weight of the jockey. We gave them 3 pieces of data, historical run times. Gave them 4 pieces of data, whatever the diet was. And we kept giving them more and more and more pieces of data. And we measured actually the level of accuracy that these people had in predicting the results of the horse race versus the actual level of confidence that people had in predicting the results. And on the next page, that's basically what you're going to be seeing there. So on the bottom x-axis there, that's the number of pieces of information we gave each one of these people. And what you can see is, as the more pieces of information we give them, the higher the confidence goes. However, and actually, the accuracy at some point becomes even lower than when you started out with. So more pieces of information doesn't necessarily mean higher level of accuracy. You might feel great about the decision you made, but again, if you're consuming so much information, you subscribe to 5 different financial newsletters, you're watching Bloomberg and CNBC like swapping on repeat, you might feel better, feel more informed about the decision you're making, but that doesn't necessarily mean that it's right. So again, understanding your overconfidence is very, very important. Why is that important? Because that could lead people to be overconfident in their ability to time the market. So if we go to the next page, and this is really, really important. One of the very, very famous expressions within our industry is not about the time, it's not about timing the market, it's about time in the market, right? And this is exactly what this chart shows you right now. So what this does is, let's say, for example, I gave you $1,000 invested in the S&P 500 in the January of 2001. So here we are 20 years later. I invested $1,000 in the S&P. I would have made $42,000 if I just bought and did not sell, did not touch it, just let it run. Let those dividends compound, let those earnings compound, and let that ride. If I just missed, and if I was trying to time the market and go in and out of the market at different points in time, if I just missed those 10 best days within 20 years, just 10 days, my returns would have more than halved. 20 days, even lower. And you can see that trend go very, very, very clearly. So it's very, very important for investors to not to try to time the market, because even if you just miss that one really good day, right, that's really going to be where it really hurts when you look at your portfolio over time. And you can see in that sort of orange box in the middle there, 6 out of the 7 best days happen right after the worst days. So if I were to tell you right now, rewind the clock back to the pandemic, in March of 2020, there was a 2-week period where the financial markets somewhat broke, right? Bonds had very limited levels of liquidity. Equity markets drew down by 20%. Nobody knew exactly what the hell was going to go around the world. Would you have bought that day? Most people didn't, right? And that's exactly what happened. So it's not really necessarily about trying to time the market, because you'll never have all the answers. Nobody, no matter how experienced of a fund manager you are, you'll never have all the answers. But the key here is to not miss out on those days, because they could very, very easily add to a significant portion of your total return. Now that's overconfidence. Now let's touch on what I find probably one of the most hilarious topics out of all of this, which is herding. On the next page, please. Now, we are thankfully in 2023 in an environment where more or less every single country in Asia is finally open, right? I've visited most of my clients across South and Southeast Asia and basically had the opportunity to see people for the first time in many, many years. The same can be said for you and for your clients and for your family as well, now that you're able to sort of bring people out and actually start traveling. So let's say, for example, next month you plan a trip to Italy. On the next page, please. And you've done so much research, right? Like I haven't traveled to Europe in so many years, right? Let me go eat at the best restaurants. Let me go eat at the this, at the that, at the this. You've planned everything to a T. You've done all your research. You've read all the reviews. You've spoken to all your friends. You've called up a local. The hotel's telling you everything. Like, this is the restaurant that you definitely have to go. You know it's great. 5 out of 5 stars. Even though it looks like that, assume it's 3 Michelin stars, right? This is the restaurant that every piece of information tells you is going to be awesome. So you arrive at that restaurant, but then you turn across the street and you see that restaurant on the right-hand side. Now, the question I'm going to ask you is, which one would you go to, right? Now, I live in Singapore, and there's a very, very hilarious saying that Singaporeans love to queue. And I can attest to the fact that how true that is. So if you put a Singaporean in between this, they will definitely go to the right-hand side. And I would say, I don't blame them. You see that ghost restaurant on the left? I would have a highly level of suspicion as to whether or not the food is going to be good. But that's exactly my point, right? We take comfort in what other people are doing as well. And you apply that to financial markets, and you can see that exactly happen on the next chart. What we've done here is we've actually tried to prove this concept in financial markets, right? So if you assume that the US economy, the US stock market, the S&P 500, is the most liquid, the most efficient stock market on earth, with some of the most sophisticated retail, professional, institutional investors in the world, then this market should be relatively sophisticated, right? Like share price will award sort of like high performing companies and vice versa. Investors likely would try to chase high-performing companies and sort of not necessarily panic when their thesis is chased down by market volatility. So to prove that, what we've done is we've actually plotted the S&P 500 in that light gray line, and we have taken mutual fund and ETF flows and plotted that in that dark gray blocks there. So anything above zero means people are buying. Anything below zero means people are selling. Now, every single period that we've circled is a rather interesting one, because I think to what Clarissa was saying, what has been happening the last couple of years? Finance 101 says you buy low, sell high. But you look at this particular chart, every single time the market goes up, people are buying. You see that those are the top peaks up there. And when every single time when the market corrects, people are selling. And this is happening on supposedly the most efficient, most sophisticated stock market in the world. You can draw this chart on any index around the world and it will look exactly the same. That is an example of herding. And you would think, oh, maybe that's just because it's retail. It's for sure it's retail, right? What about professional investors? Now let's go to the next page. And this is a really interesting one, and I need to explain this chart a little bit for you. And this is an example of us as financial professionals understanding human biases in terms of making decisions so that we don't follow the same path. Have you ever wondered why whenever you look at stock markets or individual stocks and you hear the phrase, analysts have upgraded earnings, analysts have downgraded earnings, and you ever ask the question, why are they always upgrading and downgrading earnings? Like, don't they just have a view the company can deliver and they can do it over time? Yes and no. Let's say you are an analyst covering Apple, for example, the makers of the iPhone, right? Now, right now, you and let's say 40 other people are paid to research Apple, have a view on Apple, and give the 2024 share price forecast for Apple. Everybody has to publish their research as of today. Now, you've done your homework, right? You've done all the research. You've spoken to Apple. You've spoken to all the competitors. You spoke to all the suppliers. You've really looked into the business. You spent days and months in Apple trying to understand the pipeline. You did all your homework. You wrote an 80-page report. You built crazy Excel models. You've done all that, like all that's been done. You have a share price in mind. But just before you're about to hit publish, let me check what the rest of the industry is saying. You came up with a share price for Apple at $120. In your view, that makes sense, right? Apple's got good pipeline. Again, just hypothetical. Actually, we don't really like Apple very much like now. Let's say hypothetically, Apple has good pipeline, good earnings growth. This Apple is going to take over the banking sector, whatever. The share price should be $120 per share. Before you click publish, let me go check what the rest of the industry, what the rest of my colleagues and competitors are saying. Right now, if you go to Bloomberg, the forecast will be from 100 to 105. Now you're asking the question, why the hell is my forecast way too high? I did all the homework. I spent months on this, right? Now, let's role play this for just a second. If I hit publish on 120, when all of my competitors are doing 100 to 105, if I'm right, I will be the hero of Wall Street, right? I'm the guy who got it so right. However, if I'm wrong, I'm going to be that one guy who got it so wrong, and I'm probably going to get fired. So from a matter of job security perspective, let me revise these numbers down a little bit. So if my 120 goes to 108, I'm still relatively high, much higher than the rest of everybody else on the list. So if I'm right, I'm still the #1 rated analyst on the street. But if I'm wrong, I'm not too wrong, right? And that's exactly what happens with every single stock covered by most of the sell-side houses. This is the reason why we do our own research. We don't rely on research done by sell-side analysts. And this is the reason why at the beginning of every year, analysts will give you a forecast. S&P 500 will be X price by the end of blah, 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 blah. Published in January. Every single month, that number will actually get revised either up or down, but it will continually get revised throughout the course of the year. And that is due to behavioral finance factors. So finally, on the next page, the last thing we'll be talking about is anchoring. Now, this is probably more useful for times when the market has really, really rallied. And we want to make sure that investors understand whether or not they should be buying or selling. But just bear with me here and assume that the market's on fire right now in a good way. So on the next page, when we're speaking to investors about new highs, right? A lot of investors are very, very hesitant to come back into the market when it's actually testing new highs, right? But in reality, new highs are not the end of the world, because whenever the stock market rallies, you tend to get a lot of new highs. It's not just one single high. So for example, if we look at 2021, right, and the green line there is S&P 500, every single time you see the market rally, so from let's say 95 to 99, you can see from 13 to 17, or from 19 to 21, every single time you see new highs, all those individual bars, that's the number of new highs in that single year. You can continually have new highs, right? So for example, in 2021, we got 70 instances where the market tested new highs and breached it and had another new high and then had another new high. But what does that actually mean? So if we go to the next page, what that actually looks like is if you were to put your money and invest it on any given day and you held it in the S&P from 1988 till now, right? A bit of a big data set. If you hold it for 1 year, you would have made 12%, 3 years, 40%, 5 years, 73%. These are all cumulative returns, right? So divide by 3, divide by 5. However, if you invested on a new high, because again, don't forget, they tend to group together, right? That number actually is even higher than investing on any given day. So that might be a bit of a break in perception that investors might think, if I buy a new high, that means I'm buying at the peak. No, it can continually keep growing for a certain period of time before the market corrects. And this is a very important distinction. The key takeaway in this slide isn't go out and always buy a new high. It's to not have that new high discourage you, because at the end of the day, all these new highs, they tend to group together in the markets as a whole. However, don't go in blind. Why? Because of the next page, you want to avoid bubbles, right? And you want to be able to see a bubble and understand a bubble for a bubble, right? And there are many instances of this around the world. Most recently, crypto, right? A lot of people put money in crypto. A lot of people lost a lot of money in crypto. All this because of speculation, right? And again, new highs don't necessarily mean always going to perform. They tend to, but you want to avoid bubbles and you want to make sure what you're investing in actually continues to have earnings, fundamentals, etc. So next page, please. 2022 was a bad year. We discussed that. 2023 continues to be a year that's testing the level of patience and rationality around the world. We got March Madness in the form of banking crisis in the US. This hilarious joke of a debt ceiling that's been going around the news, which is sort of makes no sense apart from political posturing. And I'm sure at some point in time, the rest of the year, we'll hear more news as well. So the key here is to avoid being emotional, understand where your biases are coming from, and really sort of like try to make these decisions from a rational perspective. Now, what can you do as an investor to safeguard your performance and avoid you yourself making these irrational decisions? On the next page, please. The easiest thing you can do without spending too much time psychoanalyzing yourself is to just diversify your portfolio. Like, it really is, in many cases, just as simple as that. Now, this performance chart goes back 10 years. It's very colorful, mind you, but each single color represents a different asset class. You can see Asia Pacific equities in purple. You can see cash in blue. You can see emerging market debt in dark green. You can see developed US IG investment grade corporate bond in purple as well, et cetera, et cetera, et cetera. And this goes every single calendar year. Couple things to note, by the way. Number one, there's not one single asset class that performs well every single year. Fact. Number two, whenever cash is the number one performing asset class, the following year it is the worst performing asset class. We're seeing that in 2018 to 2019. We're seeing that in last year as well as this year. However, you see those blue boxes that I've highlighted? Never the highest, but crucially, never the lowest. And if you stretch that performance back to 10 years, you look at that right-hand side, two columns, second highest annualized return with a moderate level of volatility. Right. So again, the best way you can do that is really just to diversify your returns so that at the end of the day, you don't mistakenly or irrationally make certain types of decisions. The other thing to bear in mind is that one of the best ways, on the next page, please, to diversify your risk is to just invest for the long run. Now, I was watching some of those fantastic ads that Sun Life was putting up earlier, and honestly, like I'm a little bit jealous we didn't think of those concepts before, because it really makes a whole lot of sense with the way Sun Life was portraying it just right now, right? You want to invest. Investing means investing, not trading, right? And there's a real benefit to investing for the long run. So, for example, if we take stocks in green, right? If we take bonds in blue, and if we take a balanced 50% portfolio of two of these things. Now, this data goes back to 1950. So we're not just plucking this out of data. This is a good 72 years worth of data here. So if you only invested in stocks and you held it for 1 year, on average, the range of outcomes can be as high as 47% or as low as minus 39%. You can see the same concept in fixed income and bonds, and you can see the same concept in 50-50. Already, investing in a balanced portfolio reduces the probability of you earning significant losses. That's holding it for 1 year. What about 5 years? Just holding the same exact asset class for 5 years reduces that range of outcomes so that now you're looking at plus 28 to minus 3. In a balanced fund, you basically have never lost money holding it for more than 5 years. And that band gets narrow and tighter and higher the longer you invest. This is a bit of an exaggerated chart, but we're just trying to make a point here. All right, so just to wrap up, and then we can open up to the fireside chat on the next page, please. Couple key takeaways. Volatility, as you saw in the beginning, is absolutely normal. Don't let this freak you out. Don't let this derail you. In many cases, it's actually an open window and an invitation to look at that as an opportunity. You saw in that previous quilt chart, diversification actually works, and it's probably the easiest thing that you can do to safeguard your own portfolio. Number 3, staying invested matters. You cannot and you should not time the market. Nobody can. It's about staying invested and making sure that you have quality in your portfolio. And number 4, stick to the plan. You and your financial advisor and everybody else already know exactly what to do. Right? The team at Sun Life, and I've worked with Sun Life now for coming on to 8 years. Right? There is a lot of thought process going into exactly how I should rebalance my portfolio, what I should be thinking about, what risks are on the horizon, how do I manage my asset allocation. All of that's already being done. You already have the plan, and don't necessarily let all these things push that aside. So I'll stop here. Happy to take any questions. If not, then I'll move it back. We can proceed to the Q&A. Thank you.
All right. Thank you very much, Anis, for that very, very insightful presentation. I think all of us have a light bulb moment now at this point in time. So I'll let you rest for a while. Before we proceed to the fireside chat, allow me to just briefly share my realizations from this discussion as well. I know our dear audience, looking at his slides, I remember the quote from a well-known investor who, accumulated his personal fortune of more than 60 billion by defying the prevailing investment trends. You all know him. He's none other than Mr. Warren Buffett. And he said here, if you cannot control your emotions, you cannot control your money. I'm sure many of you will agree with that. So how you behave is more important than what you know. As Anis showed in his slides, more information breeds confidence, not more accuracy. Now, having the proper behavior will really help you more, not just in the short term, but at the same time for long-term investing. And I think, making mistakes in investing is inevitable, as no one really has the crystal ball to see where the market is headed. So a strategy that we can do in order to have an allowance or make room for error is, by keeping cash on our end. That's the peso starter fund and the dollar starter fund that you can consider. You can deploy whenever you want to enter the market again. So peso starter fund and dollar starter fund should be in everyone's portfolio. And one more thing before we move on to the fireside chat. On the next slide, we got this from the book of The Psychology of Money by Morgan Housel. It says there that volatility in the market is inevitable. Think of volatility or uncertainty as a fee. The higher the fee you pay, the greater the potential returns. So the analogy used there was when you pay, let's say, $100 for tickets to Disneyland. where you can expect more exciting rides as opposed to, let's say, paying $10 in a local fare. That is the higher fee. But at the same time, you also get higher returns. So the trick here is to really making yourself believe that the fee in this context, the volatility, is worth the returns. All right. So now let's move on to the fireside chat. Allow me to call back here on the virtual stage, Mr. Anis Tiasiri, and our very own head of global funds and OIC head of equities, Mr. Miko Vergara, to shed some light in some interesting questions related to, some pressing issues we have right now. So I think Miko is here. Okay. So hello, Anis and Miko. Let's start with the first question. This one, I'll give this to Anis. Anis, in our current market environment, for equity investors, can you give us some tips to overcome overconfidence?
Overcome overconfidence. I think in many cases, and okay, real talk, the best thing to overcome overconfidence right now is to not take everything you hear in the news for granted.
Mm-hmm.
I think this is really, really important. And I can sort of dance around this, but what's been happening in media, not just sort of like TV media, but sort of print media and sort of like social media specifically, is to over sensationalize things a lot, right?
Yeah.
And I know we'll be touching on the debt ceiling and things like that in just a second, but a lot of the times, a lot of these sensationalist news doesn't necessarily have a lot of bearing in terms of what's happening on a corporate fundamentals perspective, right? For example, going back to Apple, right? So do you think right now the US extending the debt ceiling is really going to affect Apple's pipeline of new products coming over the next couple of years? A lot of these things really just adds to volatility. And a lot of investors tend to get a lot of information from these news outlets because, again, they're very flashy, they're very loud. One of the best things I would say is don't necessarily take everything you hear in the news for granted. Know that all they're trying to do is get the views, right? And that's the number one thing in terms of overconfidence. The other thing is, I think we alluded to just right in the presentation, is try not to time the market. That's the best. That's really sort of like the worst thing you can do. You can use market drawdowns in terms of picking up and accumulating positions, but in reality, like you cannot be that confident in really sort of like trying to really time things.
All right. So thank you for that valuable insight, Anis. I think we can relate that to the second question we have here. Question number 2. Is it still a good time to invest in global equities or are we too late? What are your thoughts on this one?
Yeah, I think if people remember the chart I showed just right now, like 2022 was probably one of the worst drawdowns in living memory, right? Like probably by far the worst since the global financial crisis. So most equity markets are only up about single digits this year. We barely recovered from the drawdown that's been happening since last year. And I know we're going to be talking about the recession, but in reality, at the end of the day, companies that can continue to deliver earnings should be compensated, and their share price can continue to go back up. All right. So I would say, don't try to again. This leads very nicely to the overconfidence question earlier, but like, don't try to time the market. Have a regular savings plan. Put that money to work over time. Let that money continue to grow. Let that money compound. So then we can stop asking the question whether we are or not too late.
All right. I love that answer. Next, let's move on to question number 3. This one is for Anis and Miko. Will this latest issue on US debt ceiling be resolved soon? This is an important question for many clients because right now I think they're very, very concerned emotionally in terms of this particular hot topic. So maybe I'll start with Miko and then Anis. Miko, your thoughts on this?
Yeah, hi Claysol. Thanks for having me. Well, hi also Anis. Good to have you back with us in this program. Well, for the funds, we don't really take views on the sector, but I think from previous episodes of this, now we've seen the Democrats and the Republicans really maximize the quote unquote brinksmanship they do. Part of it's really to it's extracting concessions from the other side. So we do have an election year coming up next year, so I think it adds a little bit of drama to this. Our base case is for both parties to really come to it. I know it's close to that June 1 deadline set by Madam Yellen, but I think it's in everyone's best interest to do this. Dollar strength is something at risk here, no? Credibility from the government is another thing. So with the dollar being sort of the global transaction currency, it's allowed U.S. households to, withstand moves up in prices. It's allowed U.S. companies to have, by default, lower cost of funding when they're looking to expand their businesses. So I think this thing really coming to a head doesn't really benefit, the parties involved. I think there's too much at risk for them to not sort of find equal footing or something to agree on here.
All right. Thank you for that, Miko. How about you, Anis? Your thoughts, please.
It's really funny because I think Miko and I, we've been doing this for quite a while. Whenever we come back to this whole debt ceiling thing again, I just have a very, very big sigh, because for those of you who may not know, this whole debt ceiling issue was put in place right after World War One as a measure of sort of controlling spending around sort of like wartime spend. So in reality, the can's gonna get kicked down the road. I mean, everybody knows this, right? So it's just a matter of how fast and furious. I'm being on trend. I know there's a new movie coming out. They're gonna really push this towards the end, right? It should not necessarily concern investors around the market. They really shouldn't feel that's sort of like passionate about it. It's just two sides of U.S. politics posturing to what Mika was saying earlier, right? And again, this is not an economic issue; it's a politics issue. And as everybody knows in politics, politicians will only make a decision when it gets really, really bad. So either we get it on the day, or it's a little bit maybe even after the day. It's basically going to be it's going to be resolved. That being said, if we want to find a worst case scenario to refer to, 2011, U.S. defaulted, right? Credit rating sort of like went down from AAA to AA, right? At that point in time, the U.S. stock market dropped, I think, around 18%, something like that, if memory serves. The day after they extended the debt ceiling, bounced right back up again. So in reality, all this does is cause a lot of noise, a lot of volatility, but it doesn't really affect the fundamental unless materially the U.S. really just doesn't sort of extend it. And then that's really not our best base case.
All right. Allow me to connect it with a live question from our audience right now, from Ms. Jinky Samson. With that current market and geopolitical scenario, such as the U.S. debt ceiling crisis, what do you think is the best asset to invest in?
It's a little hard to say, given that everybody has a different level of risk tolerance.
Mm-hmm.
I will steal an answer from my multi-asset team, which I think Miko will appreciate. The probability of outcomes, given all this noise around debt ceiling, U.S. banking crisis, and I'm pretty sure we're going to be talking about recession in just a second, but the range of outcomes of whether or not we get a recession or not get a recession, whether that recession is hard landing or soft land or soft, probabilities are more or less equally weighted at this point in time. So from an investor's perspective, this is not the time to be taking excessive risk. You should be looking at volatility as opportunities, but this isn't the time to be taking excessive risk. So if you have a benchmark, stay close to it, right? If you have very thematic equities, maybe if there is the option, take profit, pare that back down. If you're going to deploy cash, deploy in core strategies, not thematic strategies at the moment, or not single country strategies, for example.
All right. So I think diversification is really key in this particular context.
Yep.
Okay, moving on to our fourth question. How have our regional clients across Asia been reacting or investing right now? On your end, in JP Morgan, Anis, what are your thoughts on this?
So, top three categories that investors have been putting money in right now. First thing is bonds, right? But not government bonds and not corporate credit. They're buying sort of like higher yielding. So there's two camps. There's clients who've been buying higher yielding paper. So high yield bonds, sort of securitized assets, buy bond funds effectively, because you can get, I would say, about 8%, 9% on a single A rated bond fund or triple B plus beta rated bond fund very, very easy right now. Because don't forget, bond markets corrected the highest in 50 years last year. So the starting point right now is very, very attractive. And the US jacked up interest rates from 0 to 5%. So your risk free is already 5, right? So first of all, people just clipping coupons, getting bonds, buying bonds. Number two, they're buying multi-asset funds, because this year, there's a lot of decisions to be made, right? Where do I position my portfolio in the like along the duration? When do I go long duration, short duration? When do I move to credit? Where do I go to equities? Within equities, like what region do I go to? A lot of decisions have to actually be made in 2023. You have to kind of get them all right. So for a lot of investors, that's just too much pressure and too much time, too many decisions to do. Let me put that in the hands of fund managers who have a framework in place and will do that for me. And if that fund happens to have an income, sure, I'll take that too. And number three, we've been seeing clients coming back to Asia Pacific, right? So US has outperformed the rest of the world for quite some time from an equity market perspective. But I think a lot of investors are looking at China reopening, whereas the rest of so China's moving in complete direction than the rest of the world. US going to recession, China has already gone through a recession, and now they're opening up again and trying to force a recovery. So we're seeing this big divergence, and investors are actually thinking, maybe the US is not the place for me right now. Let me come to Asia Pacific because you get China and all the spillover benefits of China as well. So those are sort of the three that we're seeing: high yield bonds, multi-asset, and then sort of Asia Pacific.
All right. Thank you for that, Anis. Now let's move on to question number 5. This is related to the banking turmoil. So the question is the banking turmoil over? Have our portfolios been trimming down exposure to financial stocks given the stress on banking stocks? Or do we load up on them given how cheap they are? Maybe I'll give this first to Miko. Miko, what are your thoughts?
Okay, thanks, Clay. So in terms of the sectors, banks fall part of, the markets, you can sort of segregate them into growth and value on the equity space, right? So it's been sort of a buzzword the past 2 or 3 years. So in the current market, or say maybe for the first quarter of this year, value up to then, value was the way to go. Right? Because if you think about it, what happened during COVID, right? So there was a big sell down across quote unquote growth sectors who have earnings really, far into the future, and a rise up in rates really affects their discounted cash flows. So that was detrimental. The move up in rates was detrimental to these types of sectors. So you have technology and whatnot. In the current, so for value, what's going for them? These tend to be lower PE or lower PB companies. So they have, stable earnings, not entirely crazy on the revenue growth, but, they have stable earnings. Their margins are quite sustained. They probably have comfortable market shares in the sections of the economy they're working in. So they're quite safe, right? And they're not valued at a premium. So these are the things that we did well over the past, say, maybe 18 months. But if you flip it, right, you flip the narrative, if rates are expected to come down, there might be a case for value to sort of soften in terms of its acceleration relative to growth. So I think banks fall part of that block. So we've had banks by default of having, say, positions in the Eurozone, positions in the UK. So banks are a big part of those indices. But I think in terms of the US specifically, it's not our base case that this will blow up into, an entire US banking sector problem. You have, for example, for SVB, it was specific to the types of clients they had within their firm. So, concentrating into one type of, into a specific customer type, that sort of curtails where you operate in. And you're affected by idiosyncrasies within that part of the market. So I think for other banks, so in Europe, we had Credit Suisse being acquired by UBS. There will be advantages for bigger players to come in and scoop up, good assets from this distressed, say, issuers, such as Credit Suisse. So it's not all bad. We may see more, I guess, aggregation of some firms using these, given these opportunistic situations. But again, our base case is not for a big banking blow up. There may be some risks of select banks, which are subject to very, very nuanced client basis or the like.
Mm-hmm. All right. Thank you for that, Miko. How about Anis? What are your thoughts on this one?
Well, it's a bit funny to be answering this question because we bought one of the banks that that failed. But okay, maybe taking a step back. I think 100% agree with everything Miko said about style rotation. We do think growth might be coming back into favor, especially in an environment where you have low economic growth. So people might get more comfortable with the idea of paying a premium for growth going forward. That aside, I think specific to the banking sector, what you've noticed is that all the banks have been going down. Well, first of all, they're regional banks. and they're all located more or less around the Bay Area or exposed to that sort of that tech universe. Banks by nature is all about, and the banking business model is about duration mismanagement, right? So banks borrow at this end and they lend at that end, right? And the whole point of this is basically, and every bank does this. They take their money and they put it and they invest it and put it to a side, right? And it just happens that there are only really just two ways that banks can actually fail. Either you have a massive like credit issue where they basically lent out so much bad loans that basically everybody defaults and you have no money left, or you have what happens now, which is effectively a bank run. Bank runs, most banks, if you're well managed and have a diversified client pool, you can basically absorb whatever deposit requests that come through. But to what Mika was saying is that you take the example of SVB, it's all just like heavily focused on the sort of venture cap, private equity, tech space. So when everybody comes to you at the same time and asks for money, you basically have to redeem everything. And in that case, they have to redeem it at a loss and pay that back. And that really was it, right? So they were too naked and exposed on their cash side, and they had over concentration of deposits on the other side. Now, do we expect more banks? Funny enough, the head of our securitized fixed income team was in Singapore last week. I just bluntly asked him that same question: how many more banks we got, right? In his view, there are about 3 to 5 banks that are under threat, but in reality, we might get another 1 or 2 more, right? Interestingly enough, flip that aside, and this might be a bit of a long answer, so apologies for that. If you had looked at this entire situation, whether it's SVB, Signature Bank, or even First Republic, right? None of the depositors have ever had an issue getting their money out. Sure, it's bad for the bond investors, it's bad for the equity investors. But as a depositor in any of these banks, I've not had an issue getting my money out at all. So the US government really came in to stop that right away. So it doesn't actually really impact the real economy. The banking sector will have a much tougher time in general because lending standards will be a little bit tighter. Banks are a little bit potentially maybe more hesitant to lend out money right now. So you might see a slowdown of activity. However, the big banks are actually going to benefit the most because we got First Republic more or less for free. Don't quote me on that, right? And that's something the government doesn't want, really. The government doesn't want JP Morgan Chase to be any bigger. But in reality, if you look at First Republic now versus First Republic a month ago, the underwriting standards now for First Republic are huge because they're effectively JP Morgan, right? So if you were to walk into a First Republic bank a month ago, try to get out a loan, the bank might have sort of like taken its time, asked you for more collateral, asked you for more documentation, be really, really hesitant. But you walk into a First Republic branch today, it's effectively JP Morgan now. Yeah, you can get that loan. That's fine. JP Morgan's our parent bank. It's all good, right? So in a weird way, all these banks that have defaulted actually become higher credit quality in a sense, right? So, and sorry, then the last question, will we pick them up if they're cheap? Cheap doesn't necessarily mean good. We'd rather put our money to work in other areas where we can actually see earnings growth at the moment. Yeah.
All right. Very good answers from Anis and Miko. Now let's talk about inflation on the next slide. It says here, given the lower inflation, do we think that the Fed will now pause on the rate hikes? Will this be a cue for a meaningful rebound in global markets? Let me ask first Miko on this one.
Okay, so for me, we look at the market in terms of what earnings it's putting out, and then the other side of it's really what valuation do we assign to it. So if you think about this year, market's up about 8-9% dollar terms. What about its earnings? What is ACWI, MSCI ACWI, the global equity benchmark, looking to put out earnings wise? It's sub 2%. So you can sort of break it down and say, I think that the bulk of the returns this year are derived from its multiple expanding. But is it the same? So parang you can argue it's not the high quality sort of earnings driven price rally or asset price rally that we should be expecting. But what about next year? So offhand, looking at the different markets, so the US, Eurozone, APAC, you have materially better earning situations for most of the markets, which make up, the global equity index. So I guess that's something we would be more keen to look to overweight in or take more outsized bets on equities wise. We don't want to be buying the market fully just because of the PE moves or PE expansion. So there is some earnings expansion right now, but it's sort of dwarfed by the PE move which we're seeing in the current year. So next year should be different. We should expect to see a bigger contribution from the earnings side of the equation there.
Mhm.
Hopefully, I think that's something that could be a buoy risk assets for next year. But I think the Fed will continue to watch out and be careful with the language. I think just the fact that they're potentially talking about pausing, I think we're not thinking about cuts yet, though. But them thinking about pausing or normalizing allows other CBs across the globe to sort of create their own directions for their own markets. So if the biggest bank sort of pauses and just treads water for a bit, it gives more flexibility to the other banks, smaller CBs, to do what they need to do in their own markets. So it should be good for equity markets too.
All right, Nico, related to that, there's this question from our live Q&A from Francis Bernardo. What's your forecast about the 2023 inflation rate? Will it slow down across different regions? What are your thoughts on this one?
Across different regions. So that's quite it's case to case, no. So for example, in the Philippines, I think food inflation is the biggest thing. So the fact that we have wheat prices, we have other soft commodities sort of coming off, expected to be, I think that lends credence to what the BSP wants to do. No, they're sort of telegraphing same thing, pause and possibly a cut. So that in the Philippines specifically, that should be supportive. In the US, it really depends on the service side type of inflation, no. So that tends to be stickier. So if you think about it, if you see food prices moving up, you could expect changes within grocery prices, within the month. In services, like for example, their cost of goods goes up. You can expect like say a car wash or whatnot to change their prices up and down, over the next quarter. So it's much stickier. If they declare a price increase, it'll likely stay there for a bit, no, barring major changes. So maybe that's the thing. It depends on the market, but I think our base case, since in the US you have PPI coming off, albeit with the labor market so strong, no, I think there's some room for it to move down. I think 4% is where Street is looking at for US inflation to go down. I don't know, Anis, did I miss anything from
Yeah,
your
no, I
perspective?
mean, I was just gonna say, like, we're looking at about, at least in the US, we're looking at about inflation at the end of the year at about 4% with the bias towards the downside. But I think, don't forget that we've come from about 9% at the peak, but we're still, 4% is still double of what the central bank actually wants, right? So the central bank wants to get to 2, right? Naturally, structurally, we do think inflation will make its way down there. It'll just take some time. But it basically means that the Fed is not going to be super aggressive in cutting interest rates, right? So they'd rather let the economy languish in a bit more of a recessionary area, like really kill inflation, and then they'll be a bit more comfortable to be more accommodative. We don't expect any rate cuts this year. We might hear some signaling in Q4 that they're thinking about pivoting, but no real action until maybe 24 at the earliest, and the first half. We don't even know when yet. Everything's super data dependent. Will that be a cue for rebound markets? I think exactly what Miko said. This year is going to be we're in an earnings rut. In 23, 24, we should see a bit of a rebound. And it depends where you see where you fall on the spectrum. But at least for me, I'm in the camp that markets are forward looking. So you might see markets start to reprice this, maybe not now, but give it some time, maybe towards the mid or later part of 2022. You can start to see people get a little bit more confident with the earnings numbers once we're actually in that recessionary period. Yeah, but any opportunities for picking things up on the cheap, you can start building positions, but don't go crazy overweight right now.
All right. Thank you for that, Anis and Miko. I think since we are also already in the topic about global markets, there's this question from the live Q&A from Jinky Samson. What do you think will be the impact of de-dollarization to the global economy and specifically to the Asia Pacific market? Do you have any thoughts on this, Anis?
I don't think that's the case. There is no option apart from the dollar. I mean, let's just be frank. We can throw as many stats as there, and I'm sure you can Google all the stats yourselves. There is no other option apart from the US. Renminbi is a far, far cry from a liquidity and controls perspective. Nobody's comfortable holding renminbi, right? So at this point in time, last time I checked was 88% or something, or 80+% of all financial transactions in the world still use the US dollar, right? Renminbi, best case scenario, you might give up 5%, but to say de-dollarization, nowhere close. Yeah, the liquidity is just too deep.
All right. Thank you for that, Anis. Another question, I'll give this to Miko from Renato Nieto. Any fearless forecast in the global market for the next 5 years that you can share with us? What are your thoughts, Miko? Next 5 years.
next 5 years.
On the global market.
Well, it's pretty tough now. I think calling a 24-month sort of situation is, is quite difficult enough. But I think offhand, no, if you're coming from, say, put it this way, you have investors benefiting from very, very high cash rates right now. So that's sort of, depending on your sort of where in the world you are, right? You're getting a net, let's say 3% net on your cash investments. I think from the data in the US specifically, assuming they're still getting their wage increases year on year, I think that seems to be the case across developed markets. You aren't seeing a massive blowout in terms of unemployment or whatnot. So people are still being paid, and then the cash rates are quite attractive. I think the fact if the Fed and the other CBs can just make sure they don't overly squeeze too much liquidity out of the system, I think that will allow for private sector companies to keep growing, adding bandwidth or whatnot, no, and should support risk assets. But I think that's the biggest risk. So people are enjoying the yields, but I don't think people will be buying the riskiest things for them. No? So for example, on the fixed income side, we can buy high yield. Some of these are yielding maybe 12%. But if we look at where treasuries are, it's quite attractive in itself. So they're for me, from our perspective, from an institutional perspective, we don't need to buy the riskiest things or the highest yielding things to support the requirements we have for our portfolios. And that may be the key for other asset allocators globally as well. So I think, assuming there's no blowout, policy errors or whatnot, or major defaults or bubbles, I think we'll keep chugging along. I think the financial sector is a lot better now than it was back in 08. So there's some comfort for me there.
All right. Thank you. Thank you for clarifying that, Nico. Now we're moving on to the Philippines. Question number 7. What major catalysts do you think will drive foreign investors back to buying Philippine stocks? PH inflation is down, BSP paused on rate hikes. Is that enough for PSEI to rebound and for foreign investors to come back? Nico, your answer on this one, please.
Okay, so not that I'm biased because I'm from the Philippine market, right? So I do look after the global portfolios for Sun Life as well. My concern or my main point would be the same as other allocators. Within the region we operate in, there are other markets we are compared against, right? So you have Vietnam, you have Indonesia, you have Malaysia, Thailand, and whatnot. So all of us operate within that basket. So with people, generally, from my meetings, people aren't even at close to neutral or slightly overweight equities. So people are enjoying soaking up the high cash rates, right? They're not deploying into high yield, they're not deploying into equities. So that sort of carves out the marginal buyer of Philippine equities in the past. No? In the past, 50% of our trade activity, P-comp-wise, was foreign guys. And these foreign guys are back in their home markets, soaking up these elevated rates, with no vol or with very, very little vol, no? Compared to picking up EM assets, which tend to swing and are subject to EM currency risks. So that's maybe point number 1. We need to see global allocators come back or deploy past their home regions. And what would it take for that to happen is a move down in rates, no? Rather a material move down in rates to make equities attractive again. The other thing for me is narrative. So if we're pitching the Philippines used to be, you're buying 15% EPS growth, you're buying a very consumption-driven market. But I would argue other markets within the region only, just within the region, have some of the same factors or catalysts we have. So there needs to be maybe a more concise story from the government, policy-wise. What are we focusing on? What makes us different from the peers, within the region who may have more liquid markets? So people come in, but I'm sure they'd like the feeling that they'd be able to exit. Right now, Philippines is about 0.1% of the global equity index. 0.1. I think at the high we were maybe closer to 0.7 or 0.8. No? So you can imagine how thinner the liquidity is, and that's been absorbed by China and other markets. So those are the two things maybe. We need rates to sort of move down to create more attractive situation for equity investors. Secondly, we need maybe a narrative from the government and some other clear-cut reason which differentiates us from our peer group within Asia Pac.
Well said, Biko. Thank you so much for explaining that. Now, I think we're down to some more practical questions. No, question number 8. I'll give this to Anis. For clients who are down in their equity funds, what can you advise? Sell, hold, or cost average now?
Yeah, I think this goes back to my sort of first section on sort of loss aversion, right? The last thing you should be doing when you're down is selling because you're locking in those losses, right? So again, first things first, what are you owning? All right, that's question number one. If you're owning quality companies, if you're owning sort of companies that continue to generate cash flow, generate earnings, that's fine, right? If the thesis holds, the thesis is sound, you can dollar cost average down, right? If what you're holding is thematic, if what you're holding doesn't necessarily generate that much revenue, that much sort of cash flow, you have questions about the long-term validity of that, yeah, you might want to sort of like potentially move that to areas, as painful as it might be, right? Move that to areas that can continue to generate growth. And like Miko said, the hurdle for companies to do well right now is very high. You have cash at 4 to 5%. A company needs to demonstrate meaningfully higher earnings for you to actually part away with your cash. Yeah.
All right. At this point, allow me to squeeze in another question, but I'll give this to Miko. This one is from Nikki Fernandez. For first-time investors, should we always choose mutual funds over active trading? What are your thoughts, Miko? First-time investors.
So if you have the means to sort of, I think for me, from a practical perspective, no, trading direct stocks, in the past, it teaches you some of these nuances better than you would feel by buying funds. So
Because it's more painful, faster, right, Miko?
yes, yeah, it's like the tuition, right? You have immediate reward there. You see a stock move up 20%, take it out, liquid top slice, you can realize the gain right away. In funds, it's a little bit, there's a little bit of a workaround, right? It's not 1:1. You see S&P move up, you're holding a US fund, you realize 1:1 the gain or the loss. So, but in another perspective, that is what you're paying for. You don't want to go all in on something you're not totally convinced at. If you don't have the time, I think $100, say, in a fund which buys say a global portfolio, gets you more issuer exposure. You're not just buying one name, as opposed to spending $100 in one name, right? So you have to be totally convinced that single name is worthy of your $100. So I think if it's diversification you're seeking, a fund gets you that. You get to buy more than you would normally be able to buy, accumulating those direct names on your own.
All right. Thank you for that very practical answer. And maybe for our last question number 9. At this point, I'll give this to Anis. For young investors who are aggressive, what kind of asset allocation would you recommend, and what funds would be good at this time?
Aggressive investors. So look, when I'm thinking young, I'm thinking sort of like 20s, right? And this is probably the same advice I would give anybody if they're thinking about their pension money as well. You have the benefit of time, right? Buy equities. Buy equities and hold. First of all, don't trade, don't buy single stocks, buy funds that's diversified, to what Mika was saying earlier. You get a fund that's actively managed, you get a fund that really rebalances over time, and you can afford to have that time. And the longer you hold something, the lower volatility it actually becomes, right? So I would say you can afford to take risk. So maybe if you're not comfortable with full equities, then a more aggressively positioned multi-asset portfolio would do well at this particular point in time. But be diversified. Maybe don't go just single country like US or whatever. Go global. Right.
All right. Thank you so much. Anis and Miko are very, amazing speakers for this afternoon session. We really learned a lot from you. A virtual applause to our speakers today. We definitely learned so much today, and I think it gives us so much opportunity to really take advantage of the market right now, coming from their perspective from our Q&A today. So at this point, let's now move on to our key takeaways. Okay, these are interesting notes from our Q&A earlier. Number 1, Asian investors are going back to bonds. Many investors have been availing themselves to higher yields from higher quality bonds, so it's good to take advantage of this as well. Number 2, Fed to pause and maybe pivot in Q3. Yes, we think the Fed is done and will start signaling a pivot late third quarter this year, which is great for those who are already invested in bonds, as we expect bond prices to go up. And then number four, China reopening has a positive spillover effect on Asian and Europe markets. Investors see the value in China reopening, and these impact Chinese or Asia Pacific equities. And then finally, for number four, we believe that the US debt ceiling will be resolved soon because, of course, it's in everyone's best interest for US not to default, right? And that being said, on the right side of your screen, ladies and gentlemen, are the different Sun Life Prosperity Funds along with our return forecast. For PSEI, we think that our index can reach up to 7,775 level by the end of 2023. That is a potential around 18% upside from our current levels right now. For clients who would like to consider WAVE or World Equity Index feeder fund, our target return is at 6 to 14% by year end, which is very much achievable because as of year to date, it's already at 9%. And for those who are invested in bonds, our forecast is at 3 to 8% by year end. Dollar Abundance, which is also a bond product, is at 3 to 8.5% by year end. For conservative clients who wants liquidity, we have Peso Starter Fund at 2.8 to 3.1% year-end forecast and Dollar Starter Fund at 2.25 to 2.75% potential returns by year-end 2023. And so at this point, let's talk about your call to action. What can you do given what we have learned from today's session? So basically, number one, as we heard from our experts today, volatility is normal. Don't let it derail you. We live in a world of uncertainty, which includes investments. So instead of, avoiding risk, I think they really emphasized it earlier, learn how to manage it, as volatility can be your friend. You can, help manage your risk by doing, the following. You have to keep learning. You regularly assess your risk profile and your time horizon and implement time-tested investing strategy, which is cost averaging. Next, diversification works. Very, very important. As we've seen in Anis' asset class return side, no single asset class ruled every year. There are years when cash, bonds, and equities outperformed one another. There are times when emerging markets outperform developed markets. So these teaches us, that sound strategy is to diversify your holdings. With the interest rate environment, consider investing in bonds. If you have local equities already, consider diversifying to global equities through WAVE. If you want to hold into your cash, consider the Peso Starter Fund and Dollar Starter Fund. Okay, and then staying invested matters. Time in the market beats timing the market. That was really emphasized earlier. Studies show that volatility significantly, decreases decreases when the time horizon is long. So we can learn from history that markets eventually recover from the downturns. And then finally, avoid emotional biases by sticking to a plan. The worst decisions are those that are made out of emotions. So the way to prevent this is by putting a system into investing. And that includes, as what you've mentioned, diversification, long-term investing, and cost averaging. Now, moving on to the next slide, you can see here that we encourage you to build the right portfolio based on your risk profile. On the right side of your screen, this is our recommended portfolio allocation. It can be conservative, aggressive, or balanced. Of course, this is a good recommendation if you're starting your investing journey, and even if you already started, no? And then for those who are invested already and you are heavily invested in starter funds on the next slide, this is now good for you to reallocate your investments to different asset classes to optimize your portfolio. I think Anis also mentioned earlier that Asian investors are really driven into bonds. So given the opportunity we have right now with bonds, take advantage of this by taking a little more risk for a higher potential returns. And then finally, for those who would like to explore global opportunities, you can take advantage of the WAVE or World Equity Index Feeder Fund, which is a peso-denominated fund that allows you to invest in global securities such as Facebook, Amazon, Apple, Netflix, Google, and the likes. Its year-to-date return is at 9% already, and our year-on-year is at 10.57. For clients who would like to invest in global markets using your dollar currency, You may explore our World Voyager Fund. This is also invested in global securities through our fund of funds arrangement with our different partners such as JP Morgan, Streetside Global Advisors, Franklin Templeton, and New Capital. Few more slides for this one. Let me just give you important reminders before I let you go. We also have here some transaction updates. Make sure that enroll your settlement bank account to make sure that your redemption will be seamless moving forward. It will allow you to enjoy better security and more accurate crediting of your funds to your bank account. And take note that this is just one-time enrollment only. So the enrollment form is actually available in our website, and your financial advisor can definitely assist you on this one. Last but not the least, we are happy to inform you that we just launched new marketing assets to give you access to more learning materials that will give you that will help you in making a bright investment decision. So there was a question earlier in our Q&A pod if we'll be able to share the recording of this session. Good news is that we have an events page that will enable you to join the latest and upcoming webinars of SLAMC. We also have YouTube playlist that you can watch. Particularly, it involves Bright Talks episodes such as this one and MF in a Minute, where you can learn more about mutual funds in a very simple and practical way. Okay, so we also curated contents and newsletters sent to our subscribed clients. All these marketing assets are being developed with you in mind as our clients. So I think that's it. We did a little bit of overtime for today, but thank you so much. Once again, a round of applause to our guest speakers. Thank you so much, Anis and Miko, for sharing valuable information this afternoon. Thank you also to our dear clients for staying with us. We hope you enjoyed our session today. Once again, my name is Claysa Solidum. Stay safe, enjoy the rest of the day. This event was brought to you by Sun Life Asset Management. Bye, everyone.